Should you, as a high-income entrepreneur, invest in real estate for the tax benefits? You've likely heard the pitch: depreciation, deductions, interest write-offs, and long-term capital gain treatment. And while those benefits are real, they often come with a hidden cost that's less discussed, especially for entrepreneurs earning north of $1 million annually. That cost, your time. In this video, I'll walk you through what real estate offers in terms of tax advantages and when it may make sense versus when it quietly becomes a second job. We'll also explore alternatives that can help you capture some of the benefits of real estate without the operational drag. I'm Omar Murillo, founder of Imperial Wealth Advisors and a certified financial planner. We work with high-performing founders and business owners to help integrate innovative tax strategies into a broader wealth framework without compromising focus, energy, or execution. So the first step is to identify the reality behind the real estate tax strategy. What's real versus what's oversold? There's no doubt that real estate provides some attractive tax features. Depreciation can significantly reduce taxable income on improved property. Interest expenses are deductible, although limited in the current tax regime. And 1031 exchanges can defer capital gains provided they are carefully executed. But many overlook key limitations and risks. Passive losses often can't offset active income unless you qualify as a real estate professional. And that's a test that most entrepreneurs generally will not meet. Rental income is subject to self-employment tax in specific structures. And with the IRS scrutinizing aggressive deductions, poorly documented real estate activity can raise audit risks. Like any other investment, real estate investments carry risk and the potential for financial loss. So let's think about the time trade-off. Owning property outright often means managing tenants, repairs, and turnover. It means handling capital expenditures that dilute your cash flow and sacrificing liquidity and concentrating risk in a single asset or location. The physician investor. Let's assume the investor is making $1.2 million a year and deploys $1 million into rental properties. Let's assume that between property management, accounting, and maintenance, the time cost amounted to 12 to 15 hours per month. Is it worth it? For some, maybe, but after some time, expenses and depreciation, there is still no guarantee of any meaningful after-tax return. A comparable allocation to other professionally managed real estate investments may deliver a higher after-tax return with zero time commitment. So that brings us to the next point. Is there a smarter path to real estate exposure? Real estate limited partnerships offer investors a way to access larger and generally more profitable properties without directly leveraging expertise from experienced professionals. This structure allows investors to participate in real estate projects with limited liability, focus on generating returns while relying on others for operational oversight. Other structures include, but are not limited to, private real estate partnerships, qualified opportunity zone funds, 1031 Delaware statutory trust platform. In general, these structures can capitalize on tax benefits, provide access to professionally managed properties, and eliminate operational responsibilities. Also, REITs and real estate debt funds. Public and private REITs provide exposure to real estate sectors with built-in diversification. Debt funds in particular seek to deliver predictable income and may offer tax advantages through portfolio-level depreciation or oil and gas pairing strategies. It is essential to recognize that these investments entail risk and carry the potential for financial loss. Additionally, they may not be suitable for all investors, so please consult with a professional before making any investment-related decisions. Now let's look at this hypothetical case study, the time-efficient strategy. Assuming an entrepreneur allocates $800,000 into a combination of private equity multifamily fund, a real estate debt instrument, and a QAZ holding with a 10-year gain exclusion potential, the result can be tax advantage distributions, no direct involvement, freed up bandwidth to grow their primary business. So where real estate fits in a strategic wealth plan, it's not real estate or, it's real estate and. When coordinated with retirement plan design, business entity structuring, and charitable gifting strategies, real estate can become a part of a synergistic tax strategy, not a silo. For example, a charitable remainder trust can help offload appreciated real estate in a tax-efficient manner. Self-directed retirement accounts may hold real estate for tax-advantaged growth in specific structures. Real estate losses can be aligned with income surges through sequencing strategies. So there are timing and life cycle considerations. There are instances where direct ownership may be advantageous, such as after a liquidity event or during a low-income sabbatical. But during your business building years, efficiency and liquidity often matter more than control, in my opinion. So what would be a time-conscious, tax-efficient approach? In my experience advising high-income entrepreneurs, the most effective tax strategies are the ones that seek to deliver consistent after-tax performance, require minimal distraction from core business activities, and integrate seamlessly into the broader wealth plan. That's why I believe that most entrepreneurs entrepreneurs are better served gaining real estate exposure through professionally managed, tax-efficient structures rather than adding the complexity of direct property ownership to an already full plate. If real estate is something you're considering as part of your tax or investment strategy, I invite you to evaluate the total picture, not just the theoretical tax benefits, because it's not just about return on investment, it's about the return on your time, your focus, and your clarity. Thank you for watching.